and or telephone number that you used to join the meeting, and therefore that information that you used will become part of the recording that is made available to the public. Okay, and I see the recording has started. So I'd like to call our August 25th, 2022 meeting to order, and I would first like to ask the board to approve our virtual procedures for today's meeting. So a motion to adopt the new procedures has been made and seconded. Is there any discussion on this pending motion? Hearing none, we'll move to the roll call vote. Brian?
I approve.
Vanessa?
Approved.
Marcia?
Approve.
Sherilyn?
Approved.
Roosevelt?
Approve.
Paul?
Approve.
Callan?
Approve.
And Carol?
Approved.
Motion carries unanimously. And Jenna, we can see the agenda now, but if you toggle back and forth, we can see other windows. Thank you. Item 2, motion to approve our minutes from the July 29th meeting has been made and seconded properly. Is there any discussion on this item? Hearing none, I'll go to the roll. Brian?
I approve.
Vanessa?
Approved.
Marcia?
Approve.
Sherilyn?
Approved.
Roosevelt?
Approved.
Paul?
Approve.
Kellen?
Approve.
And Carol?
Approved.
Motion carries unanimously. Item 3, a motion to approve 138 pension applications and 79 withdrawal applications has been made and seconded. Is there any discussion on this pending item? Hearing none, we'll go to the vote. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approved.
Roosevelt?
Approved.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approved.
Motion carries unanimously, and that moves us into section 4. 4A, a motion to approve the service-connected disability benefits for Patricia Daly has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the vote. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Deny.
Roosevelt?
I approve.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approved.
The motion carries 7-1. 4B, a motion to approve the service-connected disability benefits for Lawrence Curie has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the vote. Brian?
I approve.
Vanessa?
Deny.
Marcia?
Deny.
Sherilyn?
Deny.
Roosevelt?
I approve.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approved.
The motion carries 5-3. 4C, a motion to approve the service-connected disability benefits for Dolores Ramos has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approved.
Roosevelt?
I approve.
Paul?
I approve.
Kellen?
I approve.
And Carol?
Approved.
Motion carries unanimously. 4D, a motion to approve the service-connected disability benefits for Kenneth Presley has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the vote. Brian?
I'll abstain.
Vanessa?
Deny.
Marcia?
Deny.
Sherilyn?
Deny.
Roosevelt?
Abstain.
Paul?
Deny.
Kellen?
Deny.
And Carol?
Abstain.
The motion fails 0-5 with 3 noted abstentions. 4E, a motion to approve the service-connected disability benefits for Carolyn Young has been made and properly seconded. Is there any discussion on this item? Hearing none. Brian,
I approve.
Vanessa,
Deny.
Marcia,
deny,
Sherilyn,
Deny.
Roosevelt,
I approve.
Paul,
Approve.
Kellen,
I approve.
and Carol.
Approve.
The motion carries 5-3. And 4F, a motion to approve the service-connected disability benefits for Kenneth Searly has been made and seconded. Is there any discussion on this item? Hearing none. Brian,
I approve.
Vanessa,
Approve.
Marcia,
approve,
Sherilyn,
Approve.
Roosevelt,
I approve.
Paul,
Approve.
Kellen,
I approve.
and Carol.
Approve.
Motion carries unanimously. That moves us into section 5A, a motion to approve the service-connected death benefits for Charles Grover, the deceased, has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the roll call. Brian,
I'll abstain.
Vanessa,
Deny.
Marcia,
deny,
Sherilyn,
Deny.
Roosevelt,
An abstain.
Paul,
I approve.
Kellen,
Deny.
and Carol.
Deny.
Okay. The motion fails 1-5 with 2 noted abstentions. That moves us into new business and the executive director's report.
Good morning, everyone. The legislative subcommittee, we were going to meet in September, but given the September schedule and the possible change in the board meeting date, we're going to shoot for early October for that. And just as a reminder, Carol, Roosevelt, Jackie, and Kellen are members of the legislative subcommittee. The medical panel RFP is scheduled to be posted on August 30th. So we will be notifying the incumbent medical providers, and of course, we will be notifying other potential medical providers to hopefully respond to the RFP. Once that is done and we get the valid responses and review them to make sure that they're valid responses, we will put together the medical panel subcommittee. We're still several months away from that, but I just wanted to let everyone know where we were in that process. The board has hired a legal assistant with the assistance of the law department. And although they will be located here and working on service-connected disabilities, being a liaison with our friends at Risk Management concerning obtaining medical documents, organizing medical documents, and working with PMA, and also working on a smaller other paralegal issues such as contract processing and so on. We think it'll be a good addition to the board. You may remember we had a legal assistant, Joanna Riley, previously. So whereas we're not, Joanna was very experienced. This person is a newer in the field, but very enthusiastic, very smart, and we think she'll do a very good job. Her name is Tabitha Scott, and her projected start date is September 19th after the onboarding process. So we're looking forward to that. Also, I should note that Elizabeth Bonner is on this meeting today. She is working with Teresa Devine. She started on Monday. Eventually, she will be replacing Teresa. Teresa will be leaving in the next month and a half or so. depending on how persuasive I could be to have her stay a little bit longer. But yeah, Elizabeth Bonner started, she's on this meeting, and so we welcome Elizabeth on board. Also, there's a couple things that I sent out, and hopefully you saw. There's a public safety, the 2022 Public Safety Conference is scheduled for October 23rd to the 26th in Nashville. I know members of the board have attended that in the past from time to time, and I know that they have very good sessions, breakout sessions, and educational information. Also, I sent I received from a colleague of mine in the law department, a longstanding colleague of mine who's very active in the DEI space, a announcement of a virtual program on September 15th from 2 to 4 p.m. It's DEI in the financial services industry. And Gary Gensler, the former chairperson of the, or the chairperson, maybe the current chairpersons of the U.S. Securities and Exchange Commission, will be giving opening remarks. It looks like a good panel. Again, that's a virtual program on September 15th from 2 to 4, and it's very reasonably priced for government employees. And finally, the NASP 2022 Legislative Symposium is a one-day affair in Washington, D.C. That takes place on September 28th. So if the board has a motion for people to attend any of these sessions or any of these programs, you would contact Teresa Devine and or Elizabeth Bonner for that. But they're three, I think, notable programs to take a look at. So that's all I had today.
Thank you, Fran. I'd like to ask the board if there's any motion regarding the travel to the, or participation in the events that Fran noted.
I'll make the motion.
Thank you, Kellen. Is there a second?
Second.
Thank you, Sherilyn. Okay, a motion to approve travel for staff and board members to the Nashville Public Safety Conference, the virtual DEI Finance Conference, or the NASP conference mentioned, was properly made and seconded. Any discussion on this motion? Hearing none, we'll go to the roll. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
I approve.
Paul?
I approve.
Ellen?
I approve.
Carol?
Approve.
Motion carries unanimously. And Carol, I think we might have been getting some feedback on your audio. There we go. It's better. Any other new business before the board? Okay, that moves us to the litigation summary. We have,
I think Adam Ellen is not here today. Adam, there's nothing of note to be reported per Ellen, except just a reminder of 2 cases in the memorandum.
thanks, Fran, and that information was included in the board packets. A motion to adjourn has been made and seconded, and hearing no objections, the motion carries unanimously, and we'll move into the deferred compensation portion of our meeting today. And the first item is approval of our minutes from the prior meeting. That motion has been made and properly seconded. Is there any discussion on that item? Hearing none, we'll go to the roll. Brian?
I approve.
Francois?
Approve.
Vanessa?
I approve.
Marcia?
Approve.
Roosevelt?
I approve.
Paul?
I approve.
Helen?
I approve.
And Carol?
Approve.
Motion carries unanimously, and that moves us into item 2, the plan update and activity report.
Nationwide. Good morning. Good morning, everyone.
Good morning.
On.
As of July 31st, the ending balance in the deferred compensation plan is $1,652,926,997.17. That's about 4.9% increase since the month of June. Total participants with account balances is 24,529. That's 39 less than the previous month. Actively deferring is 19,171. We saw a decrease of 7 less since the month of June. New enrollments is 62 received in July. Year to date, we've received 631 new enrollments. Thank you to HR and staff for supporting us with outreach efforts. Inactive participant is 5,358. That's 32 less than the previous month. In the 401A plan, the ending balance as of July 31st is $1,773,401.50. That is 5% increase since the month of June. 848 participants, which is 2 less than the previous month. In terms of call volumes handled, in July, the Solution Center handled 3,158 phone calls. That's a decrease of 162 less than the previous month. Participants continue to set up an online account. Overall, 73% of participants that have an account balance does have an online account, which is very, very good. In terms of percentage options, as of July, 1,201 participants have set up a percentage contribution, which is an increase of 29 more than the month of June. In terms of the after-tax contributions, which is the Roth 457 plan, total participant count is 4,508. Now you're going to see about 153 less than the previous month. And the reason why is we looked at every participant by age group. Anyone that had zero balance was removed. So that's why you're seeing the adjustments overall. The total plan assets in the Roth contributions is about 25.2 million. Please let me know if you have any questions. Happy to answer them. If not, I will pass it on to Brad to discuss the service activity report.
Thanks, Bina.
Good morning, everyone. So the local office staff for the month of July conducted 76 consultations that resulted in 41 enrollments for the month conducted through the staff. There were 6 group events and workshops. Total attendees were 186. Next month we'll report out. We started our webinar series again with the city of Philadelphia, and we had our first webinar had I think 94 attendees. It was titled Retirement 101, and we had Investment 101. These all happened in the month of August, but I wanted to let you all know. On Monday was the first day of Christina Gibson, our new senior retirement specialist. She'll be introduced next month's call to the board. And that is my report, if there are no questions.
Thanks, Brad. Any questions for Nationwide? Okay. Thank you. I think that moves us.
I have one quick question, Jackie.
Go ahead, Marcia.
Do we survey our employees to understand if there's anything we should be doing differently with regard to either our communications or programming that we're offering, or what they'd like to see? Because I know we talked amongst ourselves about the programming, and I think the programs that you're offering for Lunch and Learns are great, but I'm wondering, is there anything where we should be doing differently or in addition to, or do they like everything that we're doing, which could be the case? I'm just, which I'm wondering, because I have to say, we're really getting an increased participation and people are very interested in planning in advance. So this is great news for all of us, but I was just wondering about that, if there's, something we could do it in addition.
Th-
Brad.
Marcia, I would say thank you, first of all, for the kind words. I would think that I would actually probably defer to Bina on if this has happened with other plans in the region that she works on. I know that in the very distant past, we did do a participant survey within the deferred comp plan, but I think that might have been 10 years ago. So that was a while ago. Bina?
Yeah, thank you. Thank you, Marcia, for that question, and thank you, Brad. So as a trend, in addition to outreach efforts, webinars, and education efforts from Brad and the retirement specialist, we also do, we can do target outreach efforts to the inactives so that those that have an account balance, but they've stopped their contributions, we can, but they're still employed with the city, we can do an outreach effort to them. Something that is taking place, and I'm happy to share that with staff as well as you, Marcia, is virtual courtyard experience, where participants can view and engage with the planning tools set up online. They can view the webinars. There's a wealth of topics, but it's a virtual courtyard experience. That's something that a lot of plans are leveraging right now because, a lot of folks are in the field, and this is at their own convenience. They can experience this digital aspect of, participating, enrolling, or increasing contributions, or learning more about the plan. I will send that information to Chris, Dominique, as well as you, and please review it. And if you'd like to leverage that option, that would be wonderful. And then, of course, targeted campaigns throughout the year.
So, Marsh, you should also know that we've also had a longstanding deferred comp educational subcommittee that has met from time to time. All these ideas are usually submitted to the subcommittee and reviewed at the subcommittee prior to going to the board. So, I would ask you to go through Chris and Dominique, and we'll put together the subcommittee, and that way at the subcommittee, everything could be reviewed and looked at before being presented to the board.
Absolutely.
Okay, that's a great idea, Fran. And what I'll do is any other ideas I have, I'll go to Chris and Danielle to talk to them.
And you may end up on the subcommittee, Marsh. I mean, we've had a lot of turnover since that subcommittee's met. So maybe we will, maybe Chris or Dominique or both could send out an email asking for, I know Carol was on the subcommittee, but other than Carol, I think we've had some turnover. So Dominique and Chris could send out an email asking who would be interested in joining Carol on that subcommittee.
Okay. All right. Great. I'd be happy to join.
Okay, great. Thanks for that. That's a great question, by the way.
Any other questions for Nationwide before we move to item 3? Okay. So item 3 is an item that was previously tabled at our last board meeting for the Nationwide Pro account discussion. I will ask if any board member has a motion regarding this item.
Jesus, sorry, Jackie, I was muted. This is Brian here.
That's okay.
I'm going to make a motion to not adopt this program at this time.
Okay.
I'm a second that, Jackie.
Thank you, Brian and Carol. A motion to not adopt Nationwide's updated proposal regarding the pro account was made and properly seconded. Any discussion on this item? Hearing none, we will proceed to the vote. Brian?
I just want to be clear. I approve, which means I am all for it, right? We're kind of doing it different right now. So
So a motion to
deny.
not adopt.
Yeah, to not approve. To not adopt. Thank you.
Francois?
Yes, I approve the motion to not adopt.
Vanessa?
I approve.
Marcia?
Approve.
Roosevelt?
I approve.
Paul?
I approve the motion to not adopt.
Helen?
I approve.
And Carol?
Approve.
Okay, the motion carries unanimously. That moves us into item 4, the second quarter deferred comp investment performance update.
Morning, everyone.
Good morning.
Turning to staff's second quarter performance report. There was a change to the report. I just want to make sure everyone is aware. On the top of page 2, there were some typos. So the assets as of June 30th, 1.57 billion, and the assets in the 401A is 1.68 million. Previously, those numbers were listed as the July assets. And then the other correction was on page 4, where you'll see 19 of the 24 funds in a lineup ranked above median. So if we turn to page 5, we'll start to talk about the performance, and the first fund, I'm sorry. The first fund that we have here is the Mass Mutual Select. You'll notice in that 3 or 5 year period, both of those periods are currently, below median. No actionable concerns at this time with this fund. 2 quarters ago, although those numbers are still below median, 2 quarters ago, those numbers were more above median. So, we are seeing an improvement. And then also the recent performance and some of the peer rankings we're seeing there is also showing us a reversal as well. So we're going to continue to watch this fund because, that recent performance we're showing almost top quartile, which is definitely an improvement from performance that we have been seeing from this fund. So we go to page 9. We're going to take a look at the real estate funds. So the first one you'll see is the Fidelity Index Fund. You may remember some time ago, the board voted to add an actively managed fund to this Fidelity Index. So, the benchmark itself, this fund is designed to track the performance of the benchmark. So it is in those longer term periods ranked below median, as you see there. I'd like to point out that the actively managed fund, in contrast, the Neuberger Berman, is performing quite well as an alternative to the passively managed fund for those looking for an actively managed option and opportunities to generate more alpha over the benchmark. And then finally, the target date funds. You're kind of a mixed bag there. You'll see the target date funds, while they're actively managed, they are actively managed to follow the underlying funds, right? And those funds are index funds. And so these funds, in essence, are also following performance of a benchmark. We don't have any, actionable concerns about these target date funds at the moment. And, of course, we will continue to monitor the performance of all of the funds. Are there any questions?
Thank you, Donna.
No.
Sure. And the Vanguard Money Market.
Sure. We can move to item 5, the Q2 Vanguard Money Market Report as well.
Actually, there it is. Okay.
It's not up.
It's not on my screen either.
Yeah, it's not on my screen either.
Jenna, I don't know if you're able to switch the view to show the.
No, that's fine. I can.
Yep, it looks like she's got it.
I can just pull it up on my own screen. A moment. Sure why it's. But the point here is without having the actual numbers in front of me, because I'm not able to pull it up on my screen either for some reason. Going with the-
I'm trying to pull it up, I'm sorry.
Sure. But while she's doing that, typically what we discuss with the money market, the assets, if I recall, were slightly over 100,000. There were no, income into the fund come from a variety of sources. Those are purchases into the plan from the mutual funds, rebates, and also dividend income. And to date, through the second quarter, there were no expenses paid from the money market.
Thanks, Dominique.
Sure, thank you.
Are there any questions on item 5? Okay. And with that, a motion to adjourn deferred comp has been made and seconded. Any discussion? Hearing none, we'll move into the investment committee and I'll turn it over to the chair.
Thanks, Jackie. Agenda item 1 is approval of the July 22nd investment minutes. So moved and properly seconded that the minutes be approved, and I will call the roll. Brian?
I approve.
Francois?
Approve.
Vanessa?
Approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
Approve.
Kellen?
Approve.
And Carol?
Approve.
Motion carries. Thank you very much. Agenda item 2 is the annual asset allocation review.
Thanks, Rob. Good morning, everyone.
Sure.
Just briefly, and then I'll turn it over to Kwaku, Dave, and the folks at Marquette. But just high level, this will be the annual asset allocation review, which includes some additional stress tests. This is a exercise that staff and Marquette go through with the board every August or September. We want to review the historical performance and current asset allocation, highlight what's gone well, and if there's anything that we think needs to be changed. In this case, we're not recommending any changes. To discuss the allocation process and how staff and Marquette view it from a long-term perspective. There'll be some high-level discussion around various economic indicators, the macro environment. And then there'll be some, commentary or brief discussion around the forward-looking addition of equities, specifically global low vol. Of course, we're happy to take questions along the way or at the end, whatever the board's preference is. But with that, I'll pass it over to Kwaku and Dave.
Great. Thank you, Chris. So with respect to this presentation, once again, this is part of an annual review that we provide around the asset allocation. The good news here is, in spite of the craziness that we've seen in the market, the downturns that we've seen in the market, we continue to see the asset allocation really working in line with expectations. And with expectations, I should say realistic expectations. So as the market has gone down, it would be
shame you have to add that part, Kwaku, realistic expectations.
Yes. And I would say that as the market has gone down, ultimately, the portfolio has gone down. But what we've really set out with the board's blessing and with the partnership with staff, what we've set out to do is have an asset allocation that will, protect during the downsides when the market goes down. There's really nowhere else to go but down. But ultimately, we want to limit how much we go down as often as possible, and then really maximize the participation on the upside. And over consistent periods, if we're able to do this consistently, it basically means that when the market recovers, we have less risk, or we don't have to do esoteric things to catch up. And then ultimately, when the market goes down, it doesn't put undue pressure on the portfolio, particularly given the fact that we're doing substantially better than the marketplace. The other thing to mention here is the cash injection that we've routinely been receiving on an annual basis, that really puts us in an enviable position where ultimately, even when the market goes down, we're protecting on the downside, but we don't have to dip into our portfolio. I should say we haven't had to dip into our portfolio to make benefit payments. So again, from an asset allocation standpoint, I do want to summarize that we're in a really, really strong position in spite of the fact that the market continues to throw hurdles our way. So this slide here just highlights here that asset allocation is the biggest component of what controls portfolio risk. And then the next slide once again reinforces the work that's been done since 2016 with respect to getting the portfolio to where it is today. And again, as we think about the objectives and the discussions we had, staff and Marquette had with the board, really the objective here was to make sure that, unlike the prior asset allocation, which had some good bets and from an academic standpoint looked like a solid portfolio, we wanted to avoid a portfolio that was academically appealing, but in the real world, the implementation, could lead to some headaches and some performance that was disappointing. So ultimately here we see that we move towards asset classes that are more stable and less volatile. So you'll see the allocation to MLPs, master limited partnerships as an example. These are exposures that are energy focused, for lack of a better term. Those were substituted for exposure to open-end real estate. And as we'll see as we go through the performance, thoughtful moves like that in the portfolio were exceedingly helpful in terms of controlling tracking error and helping performance both on the upside and the downside. The next slide, please, takes us to the current asset allocation. So don't really have to spend too much time on this particular slide. The takeaway here is some changes, substantial changes, I should say, had been made between the old allocation, so pre-Marquette through till today. The next slide here, again, really just takes into account all the work that's done from the trustee side of things, from staff side of things, and then naturally from the consultant side of things. So here is a timetable that really just underscores the works, the meetings, the due diligence, the education sessions or the trustee symposiums that we've had. So, the nice thing about this annual review is, once again, it does reinforce the thoughtfulness and the deliberate nature behind the changes that have been made, and then the ongoing analysis of those changes that have been made in the asset allocation. The next slide after that and the slide after that continue to highlight actions that have been taken in the portfolio, manager searches, education, and so on. We continue with, again, an itinerary of items that have been completed by staff and Marquette, and then ultimately with the board's oversight. So this number of pages, I think, should hopefully reinforce all of the heavy lifting. It's really taken a village to get us to this really good point from the asset allocation standpoint. So we finally do get back to the slide, performance attribution, a one-year look back. And it is a good thing. I would say it's a good thing, the summary of action items taken. It's a good thing that there's a lot of pages there, because again, from an oversight, from a governance, from a due diligence standpoint, it really points to just how much energy, effort, and diligence has been taken over the portfolio. And this slide here really gives us our proof statement where we think about attribution. This is a one-year look back. So it's been, as noted earlier, a very tough period in the capital markets. And with respect to that tough period in the capital markets, you'll actually see that our portfolio performed better on the downside than the fund composite. And, that is the type of return attribution we're looking for in a down environment, where everything or most asset classes are going down. So over the one-year period, you see here that the portfolio is held up nicely, but then over the 3-month, over the 1 month, really nice downside protection from the portfolio. The next slide, please. Takes us to 4Q21. We look at 4Q21 because that's essentially a 1-year reporting period. It allows us to see what 2021 looked like for the portfolio. 2021 was a solid year, so we just spoke about the tough environment we've been through in 2022, but we also want to highlight that in up environments, the portfolio has also participated really strongly in market rebounds. So the portfolio has defended when the market's gone down, the portfolio has rebounded when the market's gone up, and that's really the proof statement to the asset allocation. So the 1-year period ending December 31st, you see across the fund composites, very strong returns coming in. Fixed income, as we know, was already going through challenges towards the latter part of 2021, but ultimately the private assets, the real assets, non-US equity, the absolute return composite, Elizabeth Park essentially, all of these were significant outperformers for us. So in a moment, I will turn this to Dave. So let me just wrap up on 1 or 2 more slides and jump into the return summary for the 1-year period ending June 30th, 2022. Once again, the purpose of these slides are to talk through performance in up markets, performance in down markets. The 2022 period that we highlight here was a period where the market was down, but you will see that the fund composite actually held up very well, particularly in comparison to the broader market. And this points to the asset allocation and components of the asset allocation really working well for us as many components of the capital markets are going through significant bouts of downward volatility. The real assets composite, so real estate, has been a significant contributor to us in this environment. The private assets or the private equity composite has also been a significant contributor. Those segments of the portfolio are examples of what's helped us in a down environment. And then the next slide, where we actually show the bars really underscore the performance of our portfolio, which is in blue, versus how many of the major segments of the capital markets performed. So again, in this negative environment where we can't avoid the negativity of the asset class performance, particularly on the equity side and fixed income side, it is reassuring to see that downside capture is significantly less than what the market is throwing out there for other plan sponsors. So with that, I'll
Quaker, could I just ask one question?
Yes,
Do you
absolutely.
know how we compare to other pension funds, other public pension funds of similar size?
So I would say of funds of the similar size. So these are the mega funds. Some are going to be significantly bigger than City of Philadelphia. Some will be a little smaller. I'd say of the mega funds, we were. This is a smaller universe. I'd say that we were ahead of the median.
Yeah.
But the entire peer group, which is a broader peer group, we were significantly above the median and going into the top quartile from a performance standpoint for that fiscal year. So both measurements where it's either a smaller subset of bigger plans or the subset of larger, the larger subset of public plans, our performance did hold up really, really well versus the universe, regardless of how you slice and dice it.
Great, thank you, Quaker.
Hey, Quaco, it's Fran. How you doing?
Hey, Fran.
Good. I just had one question. The real assets and the private assets, are those plus figures that you're showing there for the fiscal year ending June 30th, 2022? Are they final valuations or are they still lagged numbers? And if they are lagged, do we expect that spread to hold once the final numbers are reported?
Yeah, absolutely. So for the real assets composite, the majority of the numbers are in because we have the core open-end real estate and the listed infrastructure. On the private equity front, there still are some returns that we're waiting for, but by and large, I'd say we have received the majority of returns in the private market space. But when the final returns do come in, we would expect maybe a little uptick at the end of the day. So these numbers are a pretty good indicator of where we expect things to fall when all is said and done and when all is final.
Oh, that's great. Okay, thanks.
Yep. Okay, so with that, I'll pass it along to Dave to walk through other slides in the presentation.
Thank you, Kwaku. Good morning, everybody. So we obviously want to be conscientious of what we are paying. The one thing that we can control with absolute certainty in any sort of portfolio is the amount that we are paying to vendors. And we've worked very hard over the years to allocate our management budget responsibly, increased allocations to passive management where it's very difficult for managers to outperform over the long-term net of fees, and then allocations to illiquid asset classes in particular, where there is a very attractive opportunity set. The fees are a little bit higher, but the opportunity to generate alpha is much, much wider. And through our collective ability to identify those managers that can capture value net of fees over the long term, while we may have seen a very modest uptick in the expense ratio, the expected risk return characteristics due to the alpha that we've added through our liquid managers has been helpful. But broadly, our expenses or fees that we are paying relative to an industry median fare favorably because of the work that we've done over the last 6 years to really drive down costs where active managers have struggled to outperform. And that's largely in large cap, mid cap, not just in some areas of developed market large cap.
So I think I understand what you're saying, that we're much lower than we had been, slightly above last year, but that's because we've added some managers who, while their fees are higher, add much more in terms of return. So on a net basis, it made sense.
Yes, sir. And we are ramping up closer to our goal allocation in private markets, and that's part of an ongoing commitment process. And obviously, as we see market value come down due to just equity market decline, private market value, as we just saw a few minutes ago, hasn't changed all that much. So that represents a larger piece than it otherwise did a year ago in the portfolio.
And Dave, just to add to that from a performance standpoint, the areas of the portfolio that Fran referenced that had the strong 1-year performance ending June 30th, these are the areas of the portfolio that ultimately have cost us more, but we've really seen the value that these segments have delivered net of fees, particularly in a down environment like the one that we're in.
Yeah, and that's Rob.
That's what I was trying to say, Kwaku, but you said it much better than I did. Thank you.
Yeah, Rob, and that's exactly, you remember, the whole board will remember, that's exactly what was stated in the discussions of the asset allocation when the board said, look, paying fees for alpha is the only spot where we would pay the fees. And that fortunately has shown to be correct thus far. So yeah, that's exactly right.
And our obligation as fiduciaries to a defined benefit plan is to ensure that we are able to pay our long-term liabilities adjusted for inflation. And we do that at the very broadest level by growing assets, generating income, and diversifying risk. And the asset classes fit into each one of those portfolio initiatives. Public and private equity are our sources of growth. Fixed income is our source of yield, and then we have diversifying asset classes like real assets and infrastructure to help mitigate volatility. And all of those asset classes really have performed over the long term as we've expected. But we certainly want to reflect on where each of these asset classes are so that we are not caught flat-footed, so that we know what to expect. And we've seen interest rates increase significantly both on the short end and at the longer end of the curve, which has impacted valuation of fixed income. Over the course of the last 2 years, we saw the 10-year Treasury move from about 100 basis points to almost 350, and it's sort of been range bound since. As a result, we are off to the worst year ever since the inception of the Bloomberg Aggregate Bond Index, and that's due almost entirely to an increase in interest rates. We normally expect that to happen. U.S. equities and non-U.S. equities are our source of growth. We expect and we're prepared for volatility. These asset classes are marked to market every day, but over the long term, we expect equities to return anywhere from, call it 7 to 8% over the long term. With lower valuations, that makes equities more attractive. That is precisely why we rebalance back into public equities during periods of downturn, so we can capitalize on that sustained asset growth. The S&P 500 price to earnings is actually now down below the 10-year average, making large cap stocks in the U.S. more attractive. And valuations now are much more in line with long-term averages. If we were to look at the same chart a year ago, very rich, among the richest levels ever across all U.S. equities. So we are rebalancing back into public equities to capitalize on more attractive valuation going forward. I think we can skip ahead to non-U.S. equities unless there's any specific questions around public equity markets, but I think we've all been following this closely and we're aware of the rebounds that normally occur within equity markets. Non-U.S. equities represents an interesting opportunity set. We are seeing different fiscal and monetary policy. The Bank of China recently lowered their rates by a very small amount when the rest of the developed markets are increasing rates. Different monetary and fiscal policy creates different opportunity sets, but obviously there are implications around volatility, especially with the strength of the U.S. dollar and different regimes across the marketplace. We think about Asia Pacific as a room for more growth. Latin America, Eastern Europe is more commodity linked environments, and then there's a healthy amount with unhealthy. There's relatively stagnant markets in Europe. Nonetheless, we think that there are some attractive valuation opportunities. We have allocations to both U.S. and non-U.S. equity to help mitigate overall risk. We've seen a very long period of U.S. equity outperforming non-U.S. equity, but that tends to be mean reverting. The prior 10 years, we saw non-U.S. equity outperform. Valuations are more attractive here, especially in non-U.S. small cap, based on price to earnings. That is precisely why we have a diversified approach to U.S. and non-U.S. equity.
And to add to Dave's comments, as we think about the asset allocation, when all is said and done, this review really underscores the fact that the asset allocation is working. It's performing how we want it to perform. While there are, tactical observations that are being mentioned in this review, there is no recommended change of course. There's no recommended tweak to the asset allocation, because really this document, as the proof statement, continues to highlight that things are, in spite of the market's attempts to frustrate us, things are going as anticipated with the asset allocation.
And then finally, low volatility or managed volatility is an asset class that we've studied extensively as a group. We've studied extensively here at Marquette, and the idea is to capture equity market growth, but with lower standard deviation of return. And I think the inclusion couldn't have come at a better time. We are seeing significant regime changes as we trend away, perhaps, from globalization. Back to domestic production and consumption, shifts in employment, shifts in use of energy. We are seeing an increase in interest rates. All of those things lead to more uncertainty and more volatility. By allocating to managers who demonstrate lower standard deviation of return, by allocating to more defensive sectors or sectors that are securities that just pair better and have correlation benefits, we are reducing the overall, or aspiring to reduce the overall volatility of our portfolio, increasing our certainty of outcomes. We've seen a lot of volatility lately, and our minimum volatility managers are expected to offer some room to suppress that volatility. And in terms of risk, if we look on slide 37, maybe one more, please. We certainly see a difference in MSCI ACWI, which is a global equity benchmark, relative to the ACWI MinVol benchmark. Lower risk, lower standard deviation of return, and all of that leads to more attractive return per unit of risk, which creates or allows us to create a more efficient portfolio. Any questions about outlook or kind of views on asset classes that underpin our portfolio? Hearing none. It is part of the annual review of asset allocation. We review stress tests to help understand what happens during periods of market uncertainty. And over the last 2 years, we've experienced plenty of that. And while this is a healthy exercise to prepare us for what's ahead, we've seen very, very strong movements as a result of COVID, as a result of inflation, as a result of rising interest rates. And I think we're now very well experienced at what happens during periods of actual stress. But generally speaking, when we think about market inflection points driven by increases in interest rates or sell-off in equities, and we could potentially see another 100 basis point increase in rates this year and into next year. Fixed income tends to be the most susceptible as interest rates increase. The weighted average cost of capital drives bond prices lower, and we see a sell-off in fixed income. And that is exactly what we've seen over the course of the last 10 years. Through the first half of the year, the Bloomberg Aggregate Bond Index was down more than 10. We saw interest rates come back down in July, and bonds improved. Generally speaking, when interest rates increase, that's during a period of economic expansion. The Federal Reserve takes action to suppress inflation. But generally speaking, when we see a well-planned period of rising interest rates, equities do perform better. This has been a little bit of an exception just during this certain period of time. But if we think back around what's happened over the last 6 years, with the exception of 18, we have seen remarkable equity market returns ranging anywhere from 12 to 30%, which is much higher than the long-term average. So perhaps the Federal Reserve has been a little slow to take action, but generally speaking, when interest rates are increasing, that is due to economic expansion and attractive equity positions. Secondly, the real assets.
So you think what's happened with interest rates and equities over the last year, I guess, is an outlier, and that will, as rates continue to go up, that will correct itself?
Yes, sir. I think that's logical. I think we could also argue that the Federal Reserve was probably a little slow to take action. Inflationary pressures probably began to mount sometime last year, but that was clouded by.
But they were transitory, so we didn't have to worry.
Yes, the Fed makes up words to cover their tracks. I think what will happen this weekend or today and tomorrow in Jackson Hole will probably offer a little bit more clarity around the path for interest rates. We're certainly seeing signs of economic slowdown. Housing prices have actually experienced their sharpest drop in 3 years. We have a very robust labor market. There are still jobs that are unfilled. We've seen wage expansion. We had 2 consecutive quarters of GDP contraction, but the personal consumption index has not trended negative. Every recession dating back to the 70s has also been complemented by a decrease in personal consumption. That has not been the case. So there's certainly the lingering impacts of an exogenous event or outlier event from COVID that distorts maybe normal policy. But the short answer to your question is yes, over a longer term period where we get more stability, more direction in interest rates, we would see equities resume their normal path, which is closer to 7 to 7.5%.
Thank you. Any other questions? All right, great. Thank you very much. That was a really helpful report. So next on, sorry, did someone have something?
I was just saying thank you, Rob.
Oh, okay. Next is the brokerage update.
Sure. Thanks, Rob, and thanks, Kwaku and Dave, for your report. On the second quarter local minority and woman-owned brokerage program, you'll recall that the board has an annual aspirational target for its public market managers to direct 35% of their trades to qualifying brokers. Positive report for both asset classes, both for the quarter and year to date. For the second quarter, equity managers directed 46% of their trades to qualifying brokers. And year to date, we're at 53%. The only second quarter outlier, and it is an outlier, but you'll notice they only made a very, very small number of trades, about $71 worth was Northern Trust. And you can see on a year-to-date basis, they are still well over the aspirational target. The third page of your report shows the breakdown by firms, by brokerage houses. You'll see there's a nice split. I think 5 of the firms received at least 12% plus of the trading commissions. And then on the fixed income side, both
Because
on a
that used
year,
to be a lot more concentrated too, right? We've diversified.
it ebbs and
amount of
flow. It ebbs and flows, Rob. I mean, there are going to be some quarters just based on the managers doing the most trading, perhaps who they have the most success with in the past, where it'll be concentrated. But this isn't a good example of a quarter where it's been spread out pretty well.
Okay, thanks.
Sure. And then on the fixed income side, also above the aspirational target, both quarter and year to date, 37% on a quarterly basis, 36% on a year to date basis, only one manager below the aspirational target. So a really positive, continued positive story there as well.
Any questions on that? All right, thanks. Let's go to the investment performance review.
Sure.
Which we kind of have already done during the asset allocation, but
yeah, and this I'll try to keep fairly brief, subject of course to any questions. Positive, strong performance on an absolute basis last month, 4.5%. And that's just below the policy benchmark of 4.6%. Essentially, all asset classes were either in line or just below their monthly targets. And when they were below, it was pretty consistent where it was just 10 basis points. That was the case for investment grade fixed income, U.S. equities, international equities, etc. We did see continued strong performance, which I think Kwaku may have alluded to, from Elizabeth Park. They were 540 basis points ahead of their benchmark for the month. Real assets performed very well on an absolute basis. We will have updated quarterly numbers from our open-ended core real estate managers in September or October, but you'll recall their numbers came in strongly last time they were updated. And then you should have received the estimated returns yesterday through Tuesday. It's been a pretty volatile month. Fund was down around 55 basis points for the month, just below the benchmark. Fiscal year to date, a little under 4%, and that is just below the cash adjusted policy index. Happy to take questions on the monthly performance if there are any.
okay. Then move on to staff report.
Sure. Quickly, securities lending, $149,823 for the month, $917,678 year to date, and $51.3 million since the inception of the program. Minority, local, and female AUM as of the end of July, 63.9% on a combined basis. 55.9% when diverse managers are broken out separately, and 9.43% for Philadelphia and surrounding areas. In terms of upcoming meetings, I believe there'll be a request to move the September meeting likely to the 29th. There is an October meeting scheduled for the 27th, and then the November and December schedule has yet to be set by the trustees. And that concludes staff's report.
Do we need to take any action to move that meeting to the 29th, or can we just say we're doing it?
I'll defer to Jim. I don't think we necessarily have to have a vote as long as everyone is okay with moving it. But Jim, I don't know if you feel otherwise.
Rob, I guess you can ask for any objections to changing it to the 29th. And if you
Any
don't hear
objections?
any, then it's
Okay.
adopted by unanimous consent.
Got it. Thanks. Any objections to moving it to the 29th? Yeah, then let's move to the 29th by unanimous consent. Thanks, Jim.
Thanks, Rob.
Any new business? Any old business? Then it has been moved and properly seconded that the investment committee is adjourned, and I'll call the full board into session. It's been moved and properly seconded that the actions taken by the investment committee be adopted by the board. We'll call the roll. Brian,
Sorry, Rob, I approve.
okay. Francois,
Approve.
Vanessa,
Approve.
Marcia,
Approve.
Roosevelt,
I approve.
Paul, Paul, if you're answering, you're muted. Kellen,
Approve.
Carol,
Approve.
motion carries. Any new business? Old business? Then it has been moved and properly seconded that the meeting is adjourned, and we are adjourned. Thank you all very much.
Thank you. Have a good day, guys. Enjoy your weekend.
Thanks, everyone.